Welcome back to The Explainer. Today, we're diving into something that is literally keeping investors up at night: why we fear financial bubbles and, more importantly, how to avoid making incredibly costly mistakes. Let's jump right in, because looking at the data, the S&P 500 is hovering right around its all-time absolute highs. Over the last 5 years, it has delivered an incredible 72% return. That's a massive number, well above the historical averages of the last 40 years. And faced with these numbers, the question echoing in everyone's mind is this the worst possible time to invest? With big tech valued in the trillions and AI driving up prices, there's this really tangible fear of an imminent crash.
So are we entering a new massive bubble? Honestly, this fear is completely understandable. To validate that feeling, you just have to look at the absolute chaos of recent years. We've navigated global pandemics, wars, energy crises, galloping inflation, and escalating geopolitical tensions. It's been total confusion. Yet amidst all this noise, the markets just keep climbing. This stark disconnect between real-world crises and stock market highs naturally makes us suspect that we are walking straight into a gigantic financial bubble.
Section 1. The fear of all-time highs. This fear causes a very real paralysis for investors. You're terrified of arriving too late to the party, but waiting around for a bubble to burst is just exhausting. The contrast here is fascinating. On one hand, investor sentiment, like the Fear and Greed Index, can shift rapidly from extreme optimism to pure fear in a matter of months. But on the other hand, the actual U.S. market has remained pretty steadily near its all-time highs through it all. It brilliantly illustrates a key concept. Our emotions and sentiment move way, way faster than the underlying economic fundamentals.
Section 2. Understanding VIX and market sentiment. So how does the real VIX index actually work? Well, it's essentially the ultimate fear index, capturing S&P 500 volatility and anxiety in real time. In recent weeks, we've seen this sentiment react sharply to just a handful of macroeconomic data points. For example, when non-farm payroll showed 172,000 new jobs against an expected 85,000, it kept unemployment low and confirmed a strong economy. Awesome, right? But immediately after, the annual CPI inflation reading ticked up to 4.2% from 3.8%. These minor tremors in the data caused the VIX to spike, creating this instant climate of uncertainty for anyone watching the market day to day.
And to complicate the picture even further, the U.S. national debt has reached absolutely monstrous levels. The United States actually spends more right now on debt interest than on many other fundamental items in its federal budget. Entering this kind of debt spiral is incredibly dangerous, and it adds a very real, solid layer of structural instability to all the anxieties that already exist in the market.
Section 3. Valuation metrics. Shiller and Buffett.
But it's not just volatility keeping people up at night. Long-term investors look at entirely different metrics, ones that measure exactly how expensive companies have become. Let's start with the Shiller P. Simply put, this indicator tells us how much we are paying for corporate earnings, adjusted for the economic cycle. Right now, the Shiller P is remarkably high, and by high, I mean historically, we've only seen these levels during very specific, scary moments, like right before the Great Depression and during the late 90s dot-com bubble. A data point like that alone is enough to make a lot of analysts sweat.
Before we panic, though, context is absolutely crucial. High valuations don't automatically mean the market is going to crash tomorrow morning. Historically, markets spend a massive chunk of time at or near all-time highs. Think about it. In an economy structurally designed to grow over the long term, passing time at peak levels is actually the norm. Assuming that an expensive market must inevitably crash in the short term is honestly one of the most common cognitive errors an investor can make. To show you just how deceptive predicting crashes can be, let's rewind 10 years. Back then, the Shiller P was already considered very high. Based on that data, forecasts told investors to expect low future returns, somewhere around 6.5% annualized. It sounded perfectly logical: pay a high price, get a lower return. Instead, the U.S. market delivered a massive 15.5% annualized return over that decade, completely crushing historical averages.
Section 4. The dot-com bubble versus today.
Pessimists often draw direct comparisons between today's AI boom and the notorious dot-com bubble. But looking closely at the comparison is super illuminating. While a company like Cisco in the late 90s saw rising shares without the real earnings growth to back it up, meaning it was driven purely by speculation, Nvidia today is seeing explosive earnings growth that actually matches or even beats its rising stock price. Today's tech giants are soaring on the stock market for sure, but their balance sheets are soaring right alongside them. Dismissing all of this as just a new dot-com bubble is way too simplistic. There is a concentration risk we can't ignore, however. The engine of this current market rally is heavily concentrated in just a few big tech names. If you look at the equal-weighted version of the S&P 500, where all 500 companies have the exact same percentage weight, the overall growth trend is much flatter. Extreme concentration isn't ideal, but the flip side is that deciding to avoid these tech giants entirely means you're missing out on a massive slice of the market's overall returns.
Which brings us to another famous fever thermometer for the market, made legendary by the Oracle of Omaha himself. The Warren Buffett Indicator simply compares the total value of the U.S. stock market to the actual U.S. GDP. Today, this indicator has crossed the 200% threshold, sitting well above its long-term historical trend. For many traditional analysts, this is the ultimate blinking red signal of extreme overvaluation.
But context matters here, too. The world has profoundly changed. Modern U.S. companies no longer operate strictly domestically. They're massive global enterprises. So comparing their total value solely to the U.S. GDP kind of starts to lose its meaning. On top of that, we've shifted from a manufacturing economy to a high-value services economy. These tech services generate enormously higher profit margins than legacy industries, and higher margins, by their very nature, justify higher valuations and higher multiples.
Section 5. The cost of waiting.
So, if markets can remain seemingly expensive or irrational for a very long time, what are the actual strategies for markets at all-time highs? Well, a lot of people think waiting on the sidelines with cash is a free, safe choice. Zero risk, right? Wrong. Waiting for the perfect moment to invest carries a highly expensive, hidden opportunity cost. If you keep your capital out of the market to avoid a potential drop, you are virtually guaranteeing that you'll miss out on the growth that happens in the meantime. You pay a steep price in lost returns just for the illusion of timing the perfect entry.
Section 6. Time beats timing. The data is the ultimate antidote to bubble anxiety. Holding for just 1 year gives you about a 75% probability of a positive return. Stretch that to 3 years and the probability climbs over 80%. But holding for a 10-year period, that pushes the probability to nearly 95%. It doesn't mean the market moves in a straight line, but it proves mathematically exactly why time beats the market 10x over trying to predict a crash. The most vastly underestimated risk is simply not being invested at all.
And this brings us to an incredibly wise Wall Street adage: time in the market is better than timing the market. Staying consistently and patiently invested over the long haul is infinitely superior to frantically trying to guess the absolute peaks and the deepest troughs. Markets will absolutely experience downturns, but knowing exactly when the bottom will hit, or if a dip is actually the start of a massive crash, is practically impossible, even for the most seasoned professionals.
So, the final question is, will you let the fear of a temporary dip cost you the certainty of long-term growth, given the macroeconomic realities, the actual earnings driving today's valuations, and the overwhelming force of 10-year statistical data? You have a choice to make. The markets will always fluctuate and headlines will forever shout about impending doom. But historical data is crystal clear. The only real bubble we risk getting trapped in is our own indecision, which ultimately leads to incredibly costly mistakes. Thanks for joining this explainer, and we'll see you next time.